Rakesh Arora, a market expert. Rakesh, good morning. Thank you so much for taking out time for us. If you could just first start with the valuations of the market. In such a scenario, the top 10 companies in the Nifty 50 pack are trading at about 12, 13 times PE versus markets at 16, 17 times. What does that tell you?
So, see, valuations have been stretched for quite some time now, and that was one of the key concerns. The earnings growth has not been coming as strongly as people had expected, though this quarter has been reasonably okay. I think there has been some positive surprises which have come through. But, the 12% earnings growth for the year, which consensus is forecasting, looks a little bit elusive even till now. So, in this context, we were expecting that the market would correct a little bit or stabilize without even considering what's happening in US or Brexit or any other place. There was a case for correction in the market, and that is actually playing out.
Do you think the correction can be, without an event, can be a very deep one?
No, so Pankaj, see, if you look at the economy is stabilized and is starting to do a little bit better. So outlook is, of an improvement from here on rather than any kind of decline. So a sharp correction is unlikely in my opinion. We might get, a few days of dips if purely driven by some events. But generally speaking, I don't think there's too much of downside in the market. At the max, we can go like 3 to 5% correction in the worst case scenario. So, it appears to me that this is a market which is buy on dips. One can wait for the event risk to play out and then probably look to enter into some of the stocks which are now correcting and available at a better valuation.
Do you think the markets is giving mid caps much more value? That is risky because that can correct quite a bit versus the large cap space?
See, mid-caps hardly have any exposure of FI investors. So the recent spate of selling has been driven by FIs who have been pulling out the money. Mid-caps are more driven by retail and mutual funds which are still seeing healthy inflows. So yes, mid-caps can correct quite a bit, but if the market is not going to correct as much as we think, I think mid-caps are also pretty safe at the moment. Secondly, some of these mid-caps in the niche space are doing much better than large caps in terms of earnings growth, etc. coming through. So I think mid-caps outperformance is likely to continue, at least in the near term, over large caps.
Right. How would you, look at the mid-cap performance or the expectation? If I look at the mid-cap index, and the expectation that the street is having, there the growth expectations are greater than 20-25%. You think that is stretched, or they don't need the economy to grow so much as the large cap space for their earnings to grow?
See, most of the large caps are carrying a baggage of the economic downturn that we saw post global financial crisis and excesses in capex, etc. Mid caps to that extent have been spared, and some of them are pretty nimble and they have been able to move to capture niche spaces for them. So we can't have a broad brush for all mid caps, but quality mid caps are tending to perform much better in an economic environment which is not growing so fast but stable with upward bias.
Right. How would you look at the flow picture into India? You think the US elections, Fed rate hike, all of that will be very important for flows into India? Or India is now a well-discovered market and we have our own consumption themes, our own changes that we are seeing in the regulatory side, and that's why flows would tend to continue?
Well, see, over a very long period, what you say is true, but for a short-term period, flows would matter quite a bit, and this will be driven by the events which play out. So obviously, the three big events everyone is watching for is U.S. elections, Brexit, and U.S. Fed rate hike. Clearly, all these things are complementary to each other. Suppose we get a different result in U.S. election, the U.S. Fed may not really be so aggressive in hiking interest rate as what consensus is believing right now. Similarly, if Brexit happens and things are not looking that great, the monetary stance of most of the central banks globally would become more accommodative. So to that extent, I would say that there's a little bit of hedge in terms of the events playing out negatively and the monetary policy and the flow of money. So in the near term, all these things are going to make an impact. But overall, I think if we are cognizant of the risks, I think the downside gets limited, because then there are mitigating factors which can be adopted by central banks, government, and that reduces the downside of these events. So most of the risk factors are very well known, and that's why I believe that downside in the market is limited, because people are prepared for these kind of events.
Right. What do you make of the auto numbers that came out in the festive season? Decent growth is what one would say. So that tells you that demand is there, underlying economic pickup is there.
Well, see, till now, most of the earnings for the companies have been driven by margin expansion, because commodity prices were going down and they benefited out of that. So now the next leg of growth can actually come only from volume pickup. And fortunately, there are some signs, at least on autos and consumer durable space, where things are starting to look up. We need to see that this trend lasts beyond just the festive season. And that should give us more comfort that consumption theme is actually starting to pick up. Obviously, there is seventh pay commission which can come to help. Then OROP is there, which should get implemented much more aggressively given the incident yesterday. So there would be support to consumption theme going forward, and autos and consumer durables are the ones which can actually benefit quite a bit from this.
Right. Despite the the base effect, as one is saying, for these auto companies, ex Maruti, you think the numbers can grow well, and that would act as a catalyst for these names, or it's already in the price?
See, I don't think analysts are ever able to forecast the turnarounds which happen accurately, because they are never able to put the high growth numbers these companies can achieve. So I would believe that there could be positive surprises on the volume side from what consensus is building in, if there is a turnaround. And secondly, also remember there's a lot of pent-up demand from the last few years. So the base is also pretty low. So a higher growth number than a normal expectation is easily possible. So I would continue to recommend holding on to these names. There's no hurry to sell down. Things are only improving from here on. And there can be positive surprises on volume growth.
What is your preference in the auto pack? What do you like?
Pankaj, I won't be really able to discuss exact names because I don't cover them so closely anymore. But clearly, four-wheelers stand out much better than two-wheelers. Because that is the normal trend which is happening, and also the penetration levels at four-wheelers are pretty low. So the growth for four-wheelers is going to be much higher than two-wheelers.
Right. So four-wheelers would be the preference over there. Let's talk about a sector which you have covered for long, and that is the cement pack. With the recent valuations and the way we have seen for cement, you think markets is just telling you that this is the price that we are ready to pay, irrespective of any M&A or irrespective of any numbers?
So, I mean, clearly there's a bit of dichotomy out there because the deals are happening at around $100 to $125 per ton, and where long-term strategic investors are coming into the companies, whereas minority shareholders are willing to give valuations of $180, $200. So it really doesn't make that kind of sense. I think expectations are running very high, and valuations are also very high for a commodity kind of business. And I see little upside for these names. So, historically also, if you look at seasonality, Q3 tends to be weaker than Q2 in terms of cement pricing. Plus the impact of higher petcoke prices means that Q3 results are not going to be that great as compared to expectations. So there will be some earnings downgrade coming in for cement companies. I think if the correction has started in some of the names, people can look to buy these names probably in December and sell in Feb, which is the kind of seasonal trade one can do when demand picks up in Q4. So wait for more correction before you look at these names.
Right, but again, you are sure that downgrades would come in whether the stock prices go down or not?
See, we can only talk about earnings, and I see that expectations are way too high. So earnings downgrades are definitely on the cards, both for FY17 and probably for some companies even FY18. And valuations are very rich. So until unless there's earnings support for these stocks which are already trading at 30-40 PE, to re-rate looks very difficult.
Right. As far as other names are concerned, so something like a Hindalco, Vedanta, the major changes that we have seen in holding pattern for Vedanta, is that good enough to re-rate, or it's again the underlying commodity strength which is being displayed by these stock prices?
Well, see, Vedanta has already re-rated from 60 level to now 220 plus. So a large part of this is already in the stock. Having said that, China holds the key for all commodity stocks, and we see continued, improvement in demand in China, which should last at least till mid 2017. So, we are still healthy, 7-8 months away from things peaking out or starting to fade downwards. So I think if somebody is holding on to these names, can hold on for another 2-3 months and look to exit on rallies. But if there are any people looking to buy afresh, I think this is not the time to buy these commodity stocks now.
Right, because of the valuations, and you would not want to pay higher because they are very cyclical in nature.
Yeah, Pankaj, normally, when commodity prices are peaking, these stocks should look cheap. But they're not looking that cheap even with these kind of commodity prices baked in. Some of these stocks are still trading at between 7 to 10 EV EBITDA, which makes me very uncomfortable because there's limit to where commodity prices can go up given the demand-supply situation. And the liquidity that we are seeing in China is largely driven by the political event, which happens in middle of 2017. So once that event is out, there's a chance that things might drift downwards, and the demand and supply balance would come into play again. Historically, the last 10-15% move in the commodity prices, doesn't start to get reflected in stock price. So we are still some time away from it. So that's why sell on rallies is the call. But buying at these levels is, not recommended.
Right, and how would you look at something like a steel pack, which is getting a protection, and because of that the numbers are coming in? But do you think by the time the protection would get over in a phased out manner, steel prices globally would be better?
Well, see, there's hope that, raw material prices are moving up, so steel prices will also move up, and probably there will be margin expansion. but at the moment it looks difficult to me that they will be able to improve on their performance of Q1. Q2 has been weaker than Q1, and Q3, Q4 they might try to go back to Q1 level, but to beat it looks difficult. And I think consensus has already built in those high margin assumptions, because nobody expected coking coal prices or iron ore prices to move that fast. So I think the upgrade potential for steel companies in terms of earnings is looking limited, and the stocks should stagnate here on till the time we see steel prices move very sharply, which may not be the case here.
Right. In terms of steel, there is still a lot of idle capacity lying worldwide, and that's why prices may not go up in a hurry.
Exactly. So, at the moment, there's a restocking demand which came in. So, inventories were running very low for most of the commodity, and even the commodity users were keeping very low inventory because prices were going down. And now there's a rush to restock, and that is increasing the demand beyond what the normal level is. Plus, there is also, winter coming in, so people normally restock before the winter because supply chain gets disrupted, especially for coal, etc. But this phenomena will last only till Jan Feb, and after that, once the inventory levels are normalized, and we're expecting Chinese demand to little bit reduce from middle of 2017. So these two factors would aggravate, the supply situation, and commodity prices should start to come off in the second half of 2017. So the best time would be to sell by Jan Feb and use the rallies which are happening right now to probably book some profits here.
Right. As far as the IT pack is concerned, do you think valuation-wise there is no doubt that they are great businesses to buy at decent valuation? Some or the other time we may see a pickup in the spending for IT, and that's when Infosys, TCS, Tech Mahindra all could benefit?
Yeah, so there are two factors. One is, the general slowdown that we are seeing in the sector, plus the changes which are happening on the digital side and automation, etc. So those are the structural issues that the sector is grappling with, and that is adequately reflected in the valuations. They've already got derated quite substantially. Now, coming to the event risk, which is, the US elections, once that is out of the way, probably I think this sector might find some kind of bottom. But is it going back up in a hurry? It looks difficult to me at the moment. But for long-term investors, I think any further dips can be utilized to build some position from a 1 year plus perspective. Near term is difficult to forecast, but longer term, I think they are reaching undervaluation zone now.
Right. And as far as valuations are concerned, they would come under the pure value investment sort of themes where growth is low, valuations are low, nobody wants to own them right now.
Well, see, there's still growth out there. It's not double-digit revenue growth that they're seeing, but they're still doing, high single-digit. And if you look at the other sectors, they are also growing at a similar kind of growth rate. Cement sector is seeing 5% volume growth, but people are happy to give 30 PE. So, on comparison, IT sector is not doing that badly. It is just that the high standards at which it was trading earlier has got moderated to a much lower number. So I think there is undervaluation, but growth is not that bad as compared to the other sectors.
And also this sector gives you a comfort that, say, even if the volumes were to decline a little bit further on, the balance sheet would remain strong. Their cash flow generation still on a yearly basis would be strong to give decent dividends or to add to the balance sheet.
Yeah, exactly. Meaning, balance sheet is not a concern at all. In fact, the concern is on the contrary, that whether they can use this balance sheet to do some consolidation in the sector and start growing again through, inorganic route. So if that starts to happen, some re-rating can happen for the consolidators. And that is bound to happen, sooner or later, as people realize that organic growth is slower. They would try to go for merger and acquisition, which should happen in the next, foreseeable future.
Right. As far as pharma is concerned, their interest has of late gone up, but their valuations are not as cheap.
Well, see, most of these companies were going through some or the other issue with US FDA, and that's why the earnings were a little bit subdued. So optically, valuations look not that cheap, but growth can come in a big way in some of these pharma names. And so I think pharma is the best placed sector currently, according to me, where valuations are reasonably okay and a strong earnings momentum can actually happen as US FDA issues are resolved. So this is one sector one should keep watch on.
As far as pharma is concerned, would you stick to the large cap space? Even the mid cap companies, some of them have done pretty well in the last 12, 14, 24 months.
So Pankaj, you have to be stock specific here because you have to look at the ANDA's pipeline and what is in offer. So it's more stock specific sector rather than broad brush. But see, some of the large companies have been under weather. So once they come out of the US FDA issue, I think there will be a general positive feel about the sector overall. And then you have to look at individual winners in various categories.
Right. But just if some of our viewers are trying to identify these pharma companies, can you just explain what are the basic things that you would look at, not taking names of the company, but you would look at a strong pipeline? How would you look at the FDA? Any management comments that you would look for if somebody wants to do their own research?
Okay, so see, first of all is, the US FDA issue. So we had all these companies like Dr. Reddy, Sun Pharma, which had faced these issues. So any sign of resolution on the US FDA front means these stocks become, a strong bias. So one needs to watch out for that. The other thing from a mid-cap pharma perspective is increasing exposure to regulatory markets like US. So whichever company has a stronger pipeline for US market, there not only they gain volume, but also their margin expansion happens dramatically. And so that is the second thing to watch out for. So I think these are the two main issues one needs to look at while identifying the stocks.
Right. And say if that regulatory shift is happening for any company, the valuations would be expensive, but one has to wait for approvals and then the growth to come in, like we've seen for a lot of mid-cap companies.
Yeah, so see, valuations might seem expensive because, people with knowledge would be positioning in those stocks, hoping for big growth to come in. Meaning non-US EBITDA margins tend to be below 20%, whereas, companies like Sun Pharma with higher US presence have been doing EBITDA margin of 40%. So earnings can actually double in a year's time if they get the strategy right. So I don't think one needs to look at valuations so closely in this sector, but more to look at the product pipeline and the approvals.
Right. So that would be, regarding the pharma pack. But just talking about some of the other names, so we've spoken about metals, we've spoken about steel, but infra as a pack needs to recover for earnings to recover. What is the sense that you're getting? Why is capex not picking up? And if one has to play the infra story, how would one play?
Okay, so, infrastructure is going to be one of the key themes over the years because government is focused on infrastructure development for growth revival. And, orders have been given out. The order book of most of the infra companies are starting to build up quite strongly. The work on the ground is starting slightly slower than what was anticipated. Partly it can be attributed to the fiscal discipline government is trying to maintain. And they've been, had to bear the additional costs because of seventh pay commission, OROP, etc. So the spending capability of government is limited to some extent. So I think once there's enough orders already handed out and once the work on the ground starts to pick up, I think infra companies will get re-rated. There's been a strong consolidation which has happened in the last 6-8 months as people were waiting for revenue growth to recover. But I think that should start to happen in the second half of FY17. And infra space is one which looks very attractive.
Right. And in the infra space, what are the pickup points that you would look at, where you would expect the pickup to happen? Because, we get these data regarding power plants, regarding the stalled projects. None of them is picking up. Probably spending on infra is not picking up. So how would you look at signs of pickup?
So, obviously, two areas where things are happening in a much bigger way. One is roads. And so for the road companies, we just have to wait and see the revenue, growth kicking in. That will give confidence that work on the ground has started. One of the issues which has happened is that government is insisting on 90% land being acquired or clearances being done. So that has been delaying the starts despite the orders being rolled out. So I think, slowly and steadily we would get into that execution phase in a much bigger way. So road companies are the ones which are looking more attractively poised at the moment. The second is railways, where there are limited plays at the moment, but, things are moving very fast. So I think these are the two subsectors under construction which one needs to look at. Because private sector capex is going to take long time. It's not on the horizon for the next 6 to 12 months at least.
So, banks like corporate banks like ICICI, any other big names would also be a part of this revival list. Can one look at them as well for any major revival?
So, there are a lot of talks which are happening, and we are also getting a lot of sound bites from, Delhi as to what government is trying to do along with RBI on dealing with NPAs, because once the NPAs are dealt with, then only, banks will be in a position to start lending again. So we are hearing about a lot of packages coming for, say, steel sector or construction industry. So once those, kind of initiatives are announced and taken, I think that should help revive sentiment for the banks. The recent sale of SR Oil has also been a little bit of a booster for some of these banks. So overall, I would say that, until unless we see some more action from the government side, banks are there in a fix at the moment. So they are stuck in a range rather, breaking out of it. So let's wait for some more clarity to emerge on how government is looking at NPLs from infra and the steel sector.
Right, but the retail banking space or NBFC, that continues to be in a sweet spot, irrespective of valuation, or now you're feeling that they're getting into a zone where returns may be very, very muted even though the growth is strong?
Well, see, valuations have obviously become stretched, especially for some of the NBFCs. But private sector banks are still looking okay, and investors can continue to invest into those. So clearly, valuations are normally tend to run ahead of fundamentals, and which is the case which has happened. So there is some caution which is required. But people can try to look at these stocks on depths. We're expecting market to correct a little bit. and these stocks can correct 10-15% pretty easily.
Right, but NBFC versus private sector, you would go with the private sector names versus NBFCs?
Yeah, given the sharp run up NBFCs have seen and the valuations, some trading at 6 price to book, it's a little bit untenable to sustain for a long period.
Rakesh, thank you so much for taking out time for us.